Good morning, everyone. Welcome to this session on the updates to FRS 102, looking specifically at changes in the lease accounting. For those that weren't in attendance last time, my name is Dickon. I am an audit partner here at HWFisher. I specialise across both corporate and not-for-profit, and joined in May, having previously spent about 15 years at Grant Thornton, where I spent time in their technical team doing the transition of IFRS 15 and 16, on which a lot of these changes are based. So we are looking at section 20 of the new standard of FRS 102, which is coming in as of 1st of January 2026. So only a few months away. So the first time we will be reporting on it will be the 31st of December 2026. So now's the time to be thinking about it, thinking about the impacts and how that might look, rather than waiting for this time next year. So we're going to be just looking on the leases. So the changes coming up, as I mentioned, the key changes here are aligning to IFRS 16, and fundamentally it is bringing the end to operating lease off balance sheet and bringing everything on balance sheet. So you're going to have a liability and a right of use asset, as though we were accounting for it probably similar to a finance lease. So obviously there are sort of pieces here now that the starting point for everybody is to go away and think about what leases they may have. Is there an underlying asset that now needs to be accounted for as a lease on our balance sheet? So that's the first point of call. There are expedients to the lease. So the key ones here, you can have the exceptions of not bringing on our short-term leases. So this is lease terms of 12 months or less, and contains sort of no purchase options. So here it's probably looking at and probably fit into this, depending on the contracts. Some of the rolling leases could be fall into that, or leases that are coming to the end in 2026. So if you've got less than 12 months left on a lease, or some of your office supplies are only sort of leased on a 12-month basis, these ones can be excluded from bringing on balance sheet with the reflective assets. The other sort of exception to the leases is low value assets. Now FRS 102 has been a little bit less prescriptive on what a low value asset is, but I think the key for FRS 102 is thinking about it not in terms of material to your business. So if you're a £100 million business, potentially a car or a van may be immaterial in the grand scheme of things on the balance sheet, and therefore considered a low value. FRS 102 that's not how you're looking at it. It's looking at it in terms of how a person on a bus, an outsider, or a third party may look at it. So these are examples of underlying assets that would not be low value. So cars and vans, doesn't matter how big the organization is, those in themselves are not low value. IFRS, when they brought this in eight or so years ago, they had a sort of a number around about $5,000 in there as a sort of guidance point. It wasn't a must, but that was the kind of guiding point, and that gives us a sort of sense and an idea of what a low value lease might be. There are some interesting discussions around things like laptops. If you lease 100 laptops, is that low value? Do you look at it at one? It's not 100% clear. There is going to be some judgment around these things, but FRS 102 has given us some guidance of thinking about, if you fit into these categories, then it isn't going to be low value. But if you do have a low value lease, and for example, potentially a photocopier or a laptop or two, then you're not going to have to treat it. You're not going to have to bring those on balance sheet. Those are treated separately, as though they continue to be operating leases under the current FRS 102. So those are the two exceptions that we'd be looking at. So short term, less than 12 months, or low value. So what are we looking at around that asset? Because that's what we're sort of looking at when we're considering whether we have a lease and whether we have something that we should be bringing on balance sheet with its reflective liability. So it should be, or could be, explicitly talked about in a contract, or it could be sort of implicitly sort of implied that this is the asset you have. There are some things to think about. Who has the substantive right to that asset? So, for example, if the lessor, in the example here, if the lessor has the right to substitute the asset, you might not have the lease, the right of use asset that you think you have. It might not meet the new terms and definitions. So it's thinking about, yes, there might be a contract that you are in effect leasing something, but doesn't meet the criteria of section 20. Are there areas that the lessor could substitute? Actually, is it your right of use? And thinking about those kind of things. So again, look back at those contracts. Is it may seem obvious that it's a lease? It sort of may even use the phrase lease, but actually, if there are some of these caveats in that contract, in those terms, it might not be as simplistic as that, and accounting for it as you would there. There are also things that's outside of the lease that may be related. So the non-lease components. So you need to think about those. Are there any additional parts to this? And then there's the practical expedient, again, of looking at a class of assets. So you need to sort of look at it in total, and you would have to use it on all assets similar in that class. But you can look to not separate the non-lease components, but you'd have to do it for all categories that fall into that class of assets. So the lease term, I think this is, another sort of key part. Once you've identified you have a lease, you've got an asset, and therefore you've got an asset and liability to bring on. How far into that should you think about? So the lease term is that non-cancelable period of a lease. So we often look at it, and historically we've looked at it under the current sort of FRS 102. We also sort of take into account that break clause that can be often there. So you might have a 10-year lease with a 5-year break clause. Now, at the start of this, and when we're looking at our leases now going into this, is periods covered by an option to extend the lease. So potentially that 10-year lease with the 5-year lease clause, that second 5 years is reasonably certain to exercise that option. Now, that reasonably certain is potentially a little bit vague, again, coming into the idea that there is going to be quite a lot of judgment around some of these lease treatments, which is why it's really worth having a look at, thinking about the impact and what that might mean sooner rather than later, because you want to be talking with stakeholders internally, but also this is something that you probably want to get ahead with your auditors and advisors sort of separately, so there isn't a sudden last minute panic at the end of the year. But that reasonably certain, that's probably quite a high benchmark. So it's not just, I think at this point, we're thinking, yeah, probably we'll extend out. There has to be a sense of, it's you've got to meet that reasonably certain. Why are you going to extend out? So, things like thinking about, has there been sort of significant, lease improvements? That we've decked the place out. Why would we leave it in 5 years' time? Is it cost effective? Are there any implications for taking the break clause? Thinking about what the lease, what the leased asset is. Is it an office space? Is it the warehouse that's in a prime location, or an office in a prime location? What is the likelihood? Is it very important to the business, to the organization? Actually, you couldn't find somewhere else of a similar asset, or a similar sort of price for that asset. So how important is that asset to the organization? So when thinking about it, when looking at your leases and those contracts, thinking about how reasonably certain, what defines that reasonably certain? What are the criteria that go, yeah, we're not gonna take the break clause at 5 years. We are going to go for the full 10 because of these things. And again, thinking about it, even if you wanted to, if all those things apply, it is a really important asset. You've spent loads of money. You thinking, it would make no sense to take the break clause. You can't hedge your bets and kind of sit there and go, well, we'll do 5 years because it just feels better, it looks better on the balance sheet, or whatever it may be. So you've really got to go through those contracts, thinking about what is the non-cancelable periods. How far can you go if there is an option to extend, and then other periods covered by an option to terminate the lease, is it's so thinking about those. But there is going to be a lot of judgment. What we'd expect to see is management creating papers, thinking about it, documenting their assumptions, why these things are there. So the section 20 does talk to this. So in assessing the length of the non-cancelable period, an entity shall determine the period of which the contract is enforceable. A lease is no longer enforceable when the lessee and the lessor each has the right to terminate the lease without permission from the other party, with no more than an insignificant penalty. So coming back to that penalty idea, is it economical to get out of the lease? How would it look? So it does talk to that. I think there's a sort of key bit here, conversely, with it. Only the lessor has the right to terminate a lease. The non-cancelable period of the lease includes the period covered by the option to terminate the lease. So we will look at that in a worked example. So what does that mean? So SID Industries here enters into a contract to lease an office space from LHB Co Limited. The contract has an initial non-cancelable period of 2 years, with an extension for an additional 1 year if both parties agree. There is no significant penalty for either party if they do not agree to extend for that additional third year. So thinking back to what we've just kind of gone through there, the initial 2 years is a non-cancelable period. It meets the definition of a contract because it creates the enforceable rights and obligations. However, the 1 year extension period doesn't meet it. It doesn't meet the definition of a contract because both parties to the lease can individually elect not to extend the arrangement without any more than an insignificant penalty. Therefore, at the start, if you were looking at this is your situation as the 1st of January 2026. You don't have the enforceable rights beyond the 2 year period, so you'd be bringing on an asset for 2 years. Thinking about that lessor's rights, so Lyra Limited, the lessee enters into a contract to lease a warehouse from Twizzler Properties Limited for 15 years. Twizzler Properties has the option to terminate the lease after 6 years. That's the lessor has the option to terminate the lease after 6 years. The fact that the lessor can terminate the lease after 6 years, we just ignore that when calculating the lease term, the lessee has an unconditional obligation to pay for the right of use asset, the warehouse, for the period of the lease, the full 15 years. So unless and until the lessor decides to terminate the lease. So that's a really sort of critical piece when we're thinking about what does the contract say, how are we looking at it. If it is only up to the lessor, the lessee, so in this situation, Lyra Limited, has to account, you have to account the full 15 years and bring on that right of use asset and the reflective liability onto the balance sheet, because there is that unconditional obligation. So there are those two sort of scenarios to try and look at and create of, right, who has that obligation, how long is that that unconditional obligation there. So that's where you're looking at. So you're identifying the underlying asset in the contract, but then thinking about the lease term, and there's some of these sort of pieces within that that can really impact the lease term, and that obviously has a significant effect on the balance sheet side of things and what you bring on to reflect that. And this is because at the commencement of the lease, the lessee shall recognise a lease liability at the present value of lease payments still to be paid and a corresponding right of use asset. So going back to that previous example and the big difference of making sure you understand the terms of the lease and the length of the contract is that's 15 years at a net present value of the future lease payments versus 6 years. So it can make a difference, and it can make a significant difference if you haven't looked into it or make wrong judgment or estimate. But if it is open and looking at those extensions and making sure it's reasonably sort of certain, that's why it is going to be quite a big judgment and estimate. That's why there's potentially going to be additional disclosures in accounting policies, but starting with that assessment of your contracts, assessment of those leases, and writing down and documenting, looking internal, presenting that to the board on how and why you think this is going to be the right of use and length of time. So that lease liability, how are we going to measure it? Is that measured at present value of the lease payments. So it's going to be discounted down. We'll get to the discount rates in a second. There are other pieces that you might need to think about within a lease. So variable payments. Now this can come in very many different guises. So variable payments, for example, retail shops potentially sometimes have to pay more to the landlord depending on turnover in the year or in the month and certain other criteria. So there are aspects that you might have to pay a variable amount based on trade. But we can only include variable payments in that initial assumption if it is linked to an index or rate. So, for example, if the lease said we are going to increase the lease amounts every year by CPI, then you would include an estimate of that variable rate in your assumptions when working through that discounted to net present value. If, on the other hand, it was a variable rate which was based on the amount of revenue or turnover you had in the year, you wouldn't estimate that. You would leave that out. It needs to be attached to an identifiable index or rate. So there are considerations again there within your variable payments. If you can link it to an index or rate, it should be included in your assumptions before you then discount it down. Other areas to think about, amounts expected to be payable under residual value guarantees, or whether or not there is an exercise price for a purchase option. And again, coming back to that reasonably certain, it's going to be exercised. So is there a commitment to buy the asset at the end of the lease term? How much is that for? And if so, that needs to be included and discounted back. If it is reasonably certain it will be exercised. So those those things should be included. Penalties for terminating the lease at the end so that is probably more reflective in that purchase option, or if it was expected, reasonably certain you were going to exit out of a lease before its due date. So that's almost onerous lease part. So those are the measurements. So that's extra pieces to consider outside of just your regular lease payment, your monthly or annual lease payment. So there are some other payments. So there's the fixed payments first, that's your starting point, but then it's considering, does the lease agreement, does the contract have any other variable payments that could be met, that should be included? And those are going to be something around the ones we note here. So, it's not necessarily common, but again, it's needing to review those contracts, and it's kind of, when you're looking at putting that paper together for the board, for the auditors, it's working through this and having that statement, these are the fixed payments, there are no variable payments to be included. Those are the considerations, documenting what you think in your review, but it is worth going back into those lease agreements just to make sure. The discount rate, this is an area that FRS 102 have probably looked to create a little bit of more ease than IFRS when they introduced it. The discount rate should be discounted using the interest rate implicit to that lease. Now, the implicit rate can be quite difficult to calculate. So can use the need for use for experts, as it's very specific to that asset. So if it can be readily determined, we'd use that implicit rate. If it can't be readily determined, you can choose on a lease by lease basis to apply an incremental borrowing rate, or an obtainable borrowing rate. Now, that is a difference in FRS 102 from IFRS, to try and make it easier for us to implement, to create a discount rate that doesn't require a huge amount of expertise and time. So that incremental borrowing rate, again, is probably a slightly more complex idea. It brings into the sort of play the amount the lessee could and would have to borrow over a similar term with a similar security. So it brings in the idea of potentially having security over that sort of asset. So therefore, it might mean that there is a slightly reduced interest rate, but it's thinking about what could you borrow with a similar security for the funds to obtain that asset. Or a similar right of use asset in a similar economic environment. So you've got to think about each, today, and things going forwards. You do revisit this and making sure that you're using the right discount rate. It's not just a one and done situation. The lessee's obtainable borrowing rate. This one is possibly a bit easier. It's a bit more straightforward. The rate of interest of a lessee would pay to borrow over a similar term an amount similar to the total undiscounted value of the lease payments. So if over 10 years, you were paying £1 million for a lease, is how much would it cost you to borrow today, to borrow £1 million from an external market, not from a parent or related party? So that's the obtainable borrowing rate. And that could be quite high. We could see some quite high numbers here, depending on the values of the leases and the situation of the organisation. But this one, that obtainable rate, is just purely borrowing that amount, not thinking about utilizing that asset as security, not having that. That's the incremental borrowing rate. So you would see differences, and that's why there are differences there. So again, some of these it's going to be judgmental. The incremental sort of aspect, or an implicit one, will have a lot more judgment and require a lot more time and expertise. The obtainable borrowing rate, again, it's that might be that you have current debt, you have similar debt, you might go to your bank to ask and get some evidence. Again, you will need to kind of obtain that evidence. It's probably slightly easier but it can't just be a best guess. There needs to be support by it. But that one is slightly more straightforward, and FRS 102 have kindly got that option in, which is makes that discount rate a little bit easier to calculate than it did under IFRS. The right of use asset, effectively, the starting point is the initial measurement of the lease liability. So you would most likely therefore see a matching number. So your balance sheet net impact would likely to be nothing. But you'd have this asset and the liability. So your starting point is to bring that asset on at the same as the lease liability. However, there's always a complication in these things. So you would think about other aspects. Are there any initial direct costs incurred that you could capitalize into that right of use asset? Lease incentives, thinking about those things, and dilapidations, estimates of obligations for cost to dismantle and restore the asset to original condition. Now, this is important, and I think this is possibly where some organizations will need to reevaluate. Traditionally, if it's a long way out, management sometimes don't consider the cost to to restore or dismantle those dilapidation costs. We do need to think about that upfront. Now, we do need to calculate that, bring that in. That will then be added to the right of use asset, and will create a bit of an imbalance between that asset and that liability. But it does need to be calculated and considered upfront. And then within that, there is judgment, because is it a current cost? Is it in 10 years? Do you have to discount that down? Does that equal the same as a roughly a current cost? So there is some judgment again around that dilapidations, but it is something that we now need to think about, consider. We need to consider it sooner than sometimes we are at the moment. So we bring those assets and that liability on. Your starting point is your fixed payments, and the net present value of those fixed payments of the liability. And your expectation is, on a lot of that will be your right of use asset will reflect that liability. From there, how will you treat that? The subsequent measurement, we're going to reduce those lease payments by the liability. We're going to reduce that by the annual payment for the lease, whatever that may be. But also in the same year, we will increase that liability by unwinding the interest. Because we brought it in at that net present value, we've discounted it down. We need to unwind that back out over the length of the lease. So you'll see your liability, and we'll get to this on a worked example shortly, but you'll see your liability reduced by the amount that you've paid in the year, but that will be offset partially by the amounts of interest, effectively the unwinding of that net present value of the future lease payments. So there's a double impact on the lease liability. The right of use asset, there are options of what model. If you're using the cost model, the expectation is you will depreciate that asset over a straight line period, but you do have to consider impairments, changes of that dilapidations, dismantling provision, should there be a movement in there. So you do have to revisit it again, and a lot of this is a revisitation each year, just to make sure it is, those assumptions, those original assumptions, be it the break clause and the expectations there, be it the discount rate or the dilapidations, they do need to be revisited. So any remeasurements are adjusted through the lease liability and the right of use asset. So you've got to revisit it, but in a simplistic way, that lease liability will be reduced by the amount that we pay out, but increased by any unwinding interest as we bring that in. And the right of use asset in a cost model is likely just to be depreciated on a straight line basis over the life of the lease. So we're going to just spend our time now trying to run through a kind of a worked example, just to really try and polite to this. You know, we try to keep it sort of relatively sort of basic, but you know, they're bringing some of those sorts just to bring it back in. So Colonel Limited signed a 10-year lease on the 30th of December 2024 to lease a bonded warehouse facility and offices. There was a break clause attached to this lease whereby Colonel could exit the lease after 5 years. Lease rentals are £180,000 per annum, payable on a monthly basis. The lease previously met the operating lease criteria of FRS 102. So what we're currently under, the current standard, is just an operating lease. It isn't a finance lease. And Colonel Limited has an accounting reference date of 31st of March, so year end 31st of March. For ease, we're keeping this one simple, but there are no upfront fees payable on inception of the lease, and no lease incentives were granted. So this is a relatively vanilla lease at £180,000 per annum, and it fits as an operating lease, not a finance lease. On the 1st of April 2026, the company could borrow money from a reputable high street lender at a rate of 8%. So this is coming back to thinking about what our discount rate is going to be. How can we do it? So our obtainable rate here is 8%. We can get that from a reputable high street lender. I think, you know, the standards here are really thinking about, you know, you can't borrow off a friend at mates rate. There's you know, you've got to have it from a reputable lender that, you know, it's demonstrable that you can get that rate. So they can borrow that at 8%. So that's going to be our discount rate. The lease payments are profiled that you have 180,000 a year, that's 15,000 a month. We've again ignored VAT and sales taxes just to keep this example very simple. So our first thoughts when we're doing this is there a contracted right? We've got this asset, so yes, we've got a lease. It's an operating lease. It's being treated as an operating lease under the current FRS 102 requirements. We've thought about actually, you know, what's the length, what's the term of this lease? We've got a break clause for the sake of argument. It's the lessee's break clause, so it's Colonel Limited have the right to exit after 5 years. It's not the lessors, as we went earlier in the examples. The lessors, we would just that ignores it. We would have to do the whole period. Here is the lessees. We've got no, for this example, we've got no you know, reasonable certainty that we'd extend out to the 10 years. So we're going to look at it over 5 years. There's a judgment there. You would expect, you know, if I was the FD of Colonel Limited, I'm going to have to explain my judgment. But for this worked example, there is no reasonable certainty that we would extend outside of that break clause. So we will look at it from 5 years from that 30th of December 2024. So we'll, you know, exiting out in 2029. So what does that look like? Well, it's important to sort of think about it in those stages. In the year to 31st of March 2026, we're accounting for it under the current operating lease expectations. So what have we done? Well, up to March 2025, we effectively had 3 months. So we paid out, we had an operating lease and paid out simply through the P&L £45,000 up to March 2025. Obviously, the new standard starts 1st of January 2026. So for us here, we've got another year, another period to the 31st of March 2026, where we've just got 180,000 as a straight operating lease expense. That means, looking at it from the new standards, what we not paid at the 31st of March 2025, there was an additional £855,000 in our 5 years sort of left that we hadn't paid. We'd expect that in the normal situation to be held in your operating lease disclosure at the back, but there's nothing on your balance sheet. As at 31st of March 2026, we've got £675,000 that has not been paid yet. So suddenly, you know, that at your 31st of March 2026 again is going to be split in your operating lease note. We've got 180,000 that's going through. So we've then run through the other years of what we've got left outstanding. So you'd, as at 31st of March 2026, you still have your operating lease as per normal. So what does that mean to us as of the 1st of April 2026? We've moved into the new standards section 20 now, and got the updated sort of terms of reference. So we ignore the previous year and 3 months that's already gone through. So what we've got left as at that 1st of April is that £675,000 that we've got here. We've got to bring that now onto the balance sheet. So we've got to think about it from that point. FRS 102 isn't making us go back and rechange as though it had always been there. So we're going to bring it on at a starting point of what we've got left at that period. So we've got to discount down our £675,000 to bring it back down to that present value of future lease payments. So here we can see the calculations. So our present value of the future lease, the committed lease payments, is going to be 563,107. A relatively awkward number for an example. We haven't rounded. That's where you get to. So where you can see we've discounted down, we used our 8%, which was the amount we could borrow from a reputable high street retailer. So that's the discount we've used. We've discounted it back down to a present value of our future payments. Now, you could go right into the details, do it on a monthly basis, but using an annual basis, we've got to that piece. So we're not restating, as said. We're just bringing that lease on and that liability. We recognise that for our 1st of April, effectively comes on at that point. So you're bringing onto your balance sheet. You're bringing on the lease liability that we've just calculated, and we're matching that with the right of use asset. For our simple example here, we haven't got any complications around dilapidations or variable payments. We haven't got any other sort of considerations around the asset and whether we should be adding more to the asset. We're just going to keep it very simple at this stage. So we're bringing those on. How does that look? You can separate it out as a right of use asset, or you can keep it within PPE and separate it out in your notes. So there's a choice there on how you do that. So you just bring that in at that 563,000. So as we say, how do we then measure that? Well, the right of use assets come on, we're going to depreciate that. So that's going to be a sort of relatively straightforward straight line basis over the lease term, and we're going to just depreciate that through. So again, keeping it simple, we're not looking at any ownership, not anything like that. So we're just going to depreciate it out over the lease term. And then you've got to obviously continue to assess that as you would with a normal asset, whether there is an impairment to be had, whether it still holds value, thinking about potentially onerous leases and those kind of things. You might still have that liability then on your balance sheet, but you might now impair the asset because it's actually not going to bring you those economic benefits that you might have. So we've got to continue to review the right of use asset, even though it matches with the liability for impairment. So as I say, onerous leases, something like that, could create a scenario where you impair your right of use asset, but that liability still exists. So on this basis, as I say, we're kind of calculating that out, £140,000, divided by 4, to give or take on the 3 months. You're doing it therefore on a straight line basis. So you're bringing in that depreciation charge. I think this illustration is probably the really sort of key sort of piece on how that looks, and that sort of differential between what we might have had previously and what we have now. So you can see that starting point of the 563 matching, that's the right of use asset and the liability. But you can see here now we have differences between those right of use, not sort of significant, but obviously if you added this up with the number of leases or other things, it could create an sort of differences on your balance sheet. But here we've got the right of use asset that is being effectively depreciated over a straight line period. We've used 4 years. We've rounded for an ease of an example here, but you depreciate that down. So that's your right of use asset going out. So you're going to have your depreciation expense. But on top of that, you're going to have another expense. You're going to have your interest expense. So that interest expense is unwinding that lease liability. So that's unwinding the present value. So we discounted it down. If we go back, just for everybody's sort of, we started with £675,000 of expected cash payments. We discounted it down to £563,000. So we've got to unwind that now over that period. And what does that mean? We're going to increase the liability, and we have an interest expense for that. So something being reflected in the P&L. This means now you've got a slightly higher initially expense in your P&L, but it's importantly, and this can have wider implications around covenants or otherwise, it is now seen that unwinding is seen as an interest expense. So it is seen differently to what you had previously, which was just an operating lease expense. You've now got a depreciation expense and you've got an interest expense. So they are going to be shown different and separately in your P&L. And they are unwinding over the period. So you unwind that now. We've unwound that at our 8%. So our lease liability has been reduced. You can see our cash outflow has stayed the same. So we've got £180,000 a year. So that's what we're paying. But that is different to the expenses that are being recognised because we're paying out that £180,000. And then we've got that final sort of 3/4 of a year at the end there. But our liability, our lease liability is being reduced at 563. You reduce it by the 180, but then it is being brought back up by that lease, the unwinding that interest expense. So it's why it then differs from your right of use asset and has different implications on your P&L. And let's not forget the lease liability then needs to be split between your current and non-current liabilities. So that will potentially again change your balance sheet for those that currently don't have non-current liabilities. You'll see that now split between, so here we go, we've got this sort of £145,000 of the, so we're expecting that to be paid out. So that's the 282 and then you're going to split that over between your current and your non-current. So something again to think about. Again, potentially if you don't have non-current liabilities at this moment, thinking about those stakeholders that might be surprised to suddenly see it in the balance sheet like that. But don't forget to break it out. So what does this, what is this impact? This is what we're sort of saying, the impact on your profit and loss. You now have that depreciation charge. You now have that finance cost. So they're going to be shown separately. They're going to be shown differently. This could have implications depending on loan covenants if you've got external debt already and sort of interest sort of cover or otherwise. It could have impact on certain KPIs or other pieces. There can be some differences just to have a think about, but fundamentally it's going to increase those interest, those finance costs. That's going to look different to the stakeholders. So again, it's worth in your management accounting thinking about that, in your presentations, any sort of board reports and things in advance of those financial statements. Start making people aware, making those stakeholders aware. The old FRS 102, we just had the operating lease, £180,000. So it's not a huge difference, but you can see that we had a one-off cost of £180,000. That's what we were paying out, and now we've got this £185,000 that first year. The balance sheet, we've got a reduction in cash. We've paid that £180,000. We've got that right of use asset. We've depreciated that down. That sits there either within your PPE and separated in your notes, or separately in that top part as a right of use asset. And then we've got a lease liability split between current and non-current. Previously, under the current FRS 102, we basically have a reduction in cash, and then in the disclosures we've got the operating lease note, which you then separate out over less than a year, 1 to 2 years, and then sort of 2 to 5 or longer. So there are some quite big differences. There will be some looks. The overall potential impacts on the bottom line might not be that different. The overall impact net on the balance sheet might not be that different, but there will be some fundamental differences there in both of those. So again, it's making people aware, considerations of whether or not there are implications elsewhere, and thinking about all those other bits. We use a very sort of vanilla example here just to really try and give it some flavor, but you've got to go and think about those judgments. First of all, how easy is it to think about your discount rate? What have you got? How can you evidence that? Start thinking about that now. What have you got? Can you go to your lenders? Can you go to a high street? Start creating that expectation. Are there any variable payments that you need to consider, or dilapidations provisions? Because this will then change that look, and the impact on the balance sheet might be bigger. So as I say, right of use assets and lease liabilities, you can either create it separately on the balance sheet, or have it sort of broken down in the notes. There are going to be a lot more sort of extensive commentary needed for this. So description of the lease arrangements, sort of just jotting around those practical expedients taken. Have you classified everything as a class of assets? Are you taking that over the class? What class of assets have you taken those expedients over? The expenses related to interest, short-term leases and low value. So right at the beginning, we talked about the idea that there were exceptions to the new section sort of 20 on that sort of new FRS 102. And then you have to then still disclose those in the back of the accounts, that this is the expense related to these low value or short-term leases. So almost like a miniature operating expense note that we currently see. You'll just have a disclosure in the back end to say these are the expenses in relation to low value or short-term leases. So you do need to consider those. You've also got to disclose variable payments not included in the liability. So coming back again, if there are some variable payments that don't meet the criteria, so that aren't linked to a fixed index, you are going to have to start thinking about disclosing those. What are those variable payments? You're going to have to put those in. You're obviously not necessarily going to have to try and calculate, but if there's a variable payment, for example, to our idea of you have to pay additional depending on your turnover in the year, whatever that additional variable payment that you paid for that year, you have to then disclose it in the back end to talk about an additional cost went through due to a variable payment in relation to this asset. So there's going to be more disclosures there, and that reconciliation of right of use assets, you're going to have to explain how you've got to that number. So there's quite a lot of disclosures in the back end that are going to need to worked on, not just the simple calculation. So again, it is worth spending the time thinking about running through those leases, start documenting those judgments, start thinking about the other areas, the short-term leases, the low value assets, the variable payments. What does that mean? What does that disclosure look like? Get it in front of stakeholders, get in front of your auditors, get their input early. Again, where there are judgments and estimates, make sure you run those past everybody early, so that you're not sitting at a year end, or having to change all of those during an audit process. So think about it early. You've still got a lot of time, but again, it's that point of it starts on the 1st of January, means you're not reporting it formally until the 31st of December if you've got a December year end 2026. But your management accounts, how are you reporting to the boards, how are you reporting to stakeholders, because you do not want to have a big discrepancy in your management accounts and your year-end accounts. So it might be as well thinking about how you update your internal accounting systems, your software, your TVs. You might have journals that automatically bring in certain operating costs, but you now need to think about adding in depreciation, right of use assets, separating out, creating new lines, new codes. So is that simple? That's for you to decide. But how do you want to make it as simple for reporting and being able to sort of follow and identify those? So there's some bits that you'll need to do in there. Clearly, that assessment of leases, there is, going to be a lot of very straightforward leases, but as we've detailed throughout this session, there are some judgments, there are some estimates that are going to be in there. It is worth revisiting those leases with a slightly more sort of detailed eye now to think about whether there's something that should be considered. Certainly the obvious ones, dilapidations, are there those sort of break clauses, what are they going to be? So assessment of those leases is going to be absolutely critical. And impact of increases in assets and that might push you into a new size of company if you've got lots of leases, lots of large leases, or you're on the border of a company size. This could push you over into a new threshold, from small to medium to large. So again, that will have reporting implications. So thinking about that, because that could be the thing that pushes you over that limit. I'm very conscious it is 9:55. We have 5 minutes left. As I said at the beginning, any questions, we will feedback in emails next week. If there's any sort of simplistic questions that have come up now, I can try and answer them very quickly, but otherwise do drop those questions in, and probably given the time, we will respond to any questions that you might have in email. If there are any questions outside of this, please do get in touch. We can help with some of these assessments if there are some complications, sadly, around the interest rates, around some of those judgment pieces. So if you need assistance, that's something we can offer. If you just want some more clarity on some of the things we've discussed today, then please do get in touch. Otherwise, it just needs to say we've got some other upcoming sessions. So there's some charity SORP sessions. We'll be putting on our website updates from the autumn statement that's just around the corner. We will be looking at another one of these sort of hour-long ones in December, doing revenue accounting and looking at that. So we're going to sort of deep dive some worked example on the revenue side of things in December, and then we've got some higher education sorts and other webinars with the changes that are coming down the track there. Obviously, as I say, if you want to sign up or you haven't signed up to those, please get in touch with Ketsia or drop me an email, and we'll look at those. I think there has been some questions. I think just given time, we might respond to those in email format as we are relatively out of time. So I'm probably going to draw it to a close there. Thank you everybody for attending.